Welcome to our discussion of Magellan's infrastructure investment portfolios. Today we've got the 5 infrastructure investment portfolio managers, Joel Amoras, Ben McVicker, David Costello, Offa Culliner and myself, Gerald Stack, to talk about the performance of the infrastructure investment portfolios over the last period, to talk about the fundamental performance of the underlying investments, the utilities and infrastructure companies, to talk a little bit about the things that we exclude and what's gone on with those, and finally to talk about the outlook and how we're thinking about the outlook for infrastructure investment as we move forwards. Offa, do you want to talk a little bit about the performance of the funds and the underlying variables?
Thanks, Gerald. Look, the performance was basically in line with thesis over the last 12 months. That's CPI plus 4 to 5, as we say, through the investment cycle. Really, that performance came largely in the September quarter. And stop and think about why that was. What we saw in the September quarter was rates came in firstly. That was certainly helpful, but also we saw a shock. So one of the reasons people invest in infrastructure is that defensive characteristics and diversification that you get. As the markets drew down in late July and early August, as markets got spooked about growth, infrastructure, in particular high quality infrastructure, performed really, really well in that period. And we carried that through the year. That said, on a relative basis, we actually underperformed the index. The key driver there was the things we don't invest in. That is the things we exclude from our definition of infrastructure. And those stocks we exclude that are included in the benchmark attributed more than 100% of the difference between our performance and the benchmark performance through the year. And in particular, oil and gas pipelines and competitive power did particularly well. And Joel will speak to those in a little while and give you some more details there. One of the other key factors through the year that I touched on earlier, rates have been quite volatile. For example, the US 10-year started at 4% for the year, approached 5% at one point, dropped back down to 3.6, and then the year at 4.6. The fact that we ended up in line with thesis for the year really speaks to the fact the market has just started to reappreciate those defensive characteristics and that diversification benefit you get, particularly for shock events like we saw in the September quarter.
All right, that's good. Look, why don't we drill down, Dave, into actually how the utilities sector performed? If we think about our universe as utilities and transport infrastructure, how did utilities go during the year?
Yeah, certainly, Gerald. The utilities in the strategy delivered extremely predictable results during 2024. Virtually without exception, our utility investments are poised to deliver full year results that are aligned with management's guidance issued almost 12 months ago. And typically, they're evolving in line with management's longer-term, medium and long-term earnings growth guidance. And when we reflect upon the long-term fundamentals of our utility holdings, 2024 saw those fundamentals not just reaffirmed, but actually saw them appreciably improved. If we take our water utility holdings, for instance, we saw in December Ofwat's final determination validate our expectations that our UK water utilities, for instance, would benefit from unprecedented levels of investment over the next 5 years and a materially higher cost of capital, supporting expectations of the fastest rates of earnings growth we've seen from the sector since privatisation in the late 1980s. With regards to our electric utilities, we've long spoken about the profound tailwinds to investment and growth from the need to replace ageing infrastructure and decarbonise our power systems. And those thematics remained firmly intact during 2024, but they were increasingly reinforced and accentuated by the re-emergence of growth in electric demand or load growth. And this became apparent during 2024 when a number of our integrated power companies issued revised integrated resource plans, which are really an estimate of their expectations of electric demand and the generation resources required to meet those over the next 10 to 15 years, that embedded vast increases in expected electric load growth, in many instances double, sometimes multiples of the previous plans issued as little as 12 to 18 months ago. So the coalescence of those three trends, the need to replace ageing infrastructure, the need to decarbonise, and this load growth, continues to support meaningful upgrades in utility capital plans. So WEC Energy, for instance, one of our utility holdings with operations in Wisconsin, Illinois, and Michigan, in November issued a revised capital plan that was 18% higher than the plan issued just 12 months prior. National Grid, with its operations spanning the Atlantic in May last year, guided to an expectation that it will spend £60 billion over the next 5 years. It was a more than 40% uplift on its previous 5-year plan. And in its third quarter earnings call, Sempra, another of our key utility holdings with operations on a regulated basis in California and Texas, guided that its Encore subsidiary in Texas is likely to upgrade its 5-year capital plan by somewhere in the region of 40 to 50% when it announces its full year results in February. Now, of course, the significance of these meaningful upgrades is that under the regulatory construct, every dollar that these utilities invests in their network earns the authorised rate of return. So the acceleration in investment yields a corresponding acceleration in earnings growth.
Okay, so not just strong earnings for these companies as a whole, but given the strength of the underlying forward-looking capital plan, an expectation of predictable earnings growth well into the future. Ben, why don't we drill down into transport infrastructure? What did we see?
Yeah, sure. So I'll touch on a couple of things, but I'll start with toll roads or motorways, as they're probably for us in a portfolio sense, the largest position. What I'd say that we saw over the 2024 year is that toll road performance was probably more mixed than it's been in prior years, where we've had a very strong recovery story coming through. What we really saw is a bit more company dependent. So for example, one of the ones that did really well last year was Ferrovial. They had a really strong performance out of their key motorway asset in Toronto in Canada. What you saw is that they announced both a toll price increase, the first time since the pandemic at the start of last year. Sorry, not announced, but put that through. And in addition to which they announced an additional toll price increase that came into effect effectively at the start of this year. So that wasn't broadly expected by the market. In addition, the management team did a really good job of rotating some of their assets. They sold some airports at what we consider to be really attractive prices through the year. And as a result, you saw that strong business performance reflected in the share price performance. Now, as I said, the performance was mixed across the space. So when we think about the other side of the ledger, you're looking at things like Vinci, which is a French-based business. What you found there is that the performance was really running up against the local market issues, where you've got instability at the political level in France. You've also got fiscal pressures from the government. And what that's led to is issues where the government has they're either looking to levies or announce specific taxes on motorway or concession companies. And so that has effectively weighed on the performance of these companies. I should add that the underlying revenue trends and business trends seem pretty reasonable for Vinci, and the valuation looks pretty reasonable to us. But for now, that effect of the local market has been reflected in the share price. I'll touch on airports briefly. Airports, you've seen some decent performance, but at an industry level, you have continued to see capacity growth and passenger growth in 2024 as you've continued that long recovery curve post the pandemic. What you really saw is something that's really in line with our thesis here, is that you've seen ongoing strength in those markets that are more geared towards sort of personal travel, leisure travel, more than anything. A really good case in point of that is Aena, who are a Spanish-based business. Key assets there for context would be Madrid Airport, Barcelona Airport. And as a result, what you saw is that they upgraded guidance throughout the year, which was, again, a strong supporter of their sort of share price throughout the year.
Okay, so again, similar theme, strong performance generally, some quid pro quo in terms of companies facing particular short-term issues. I guess then the question becomes, Joel, we've seen utilities do well, transport infrastructure do well. They are the two broad components of the bucket that we invest in. We exclude things like power companies because they face power prices that move up and down. They face competition. We exclude oil and gas, energy, infrastructure, where their earnings are impacted by oil prices. But these are two sectors that have done really well during the year, and therefore have hurt our relative performance. Do you want to talk a bit about what's going on in those particular sectors?
Sure, there are a couple of negative influences which you pointed out relative to our performance, and both of which, again, we exclude from our investable universe. Now, the first one which you mentioned, the power companies, the merchant and unregulated companies within the US. Now, if you were invested in these companies, you would have done tremendously well, really on the back of the dramatic growth in data centers, where we've seen insatiable demand for significant and predictable power supply. And the reason why these companies have done so well over the last 12 months, so the share prices have done so well, is because they've been able to provide solutions for developers of data centers. We've seen instances where they've either reopened or extended the life of nuclear assets, and some have also delayed the retirement of gas plants. Now, in return for these solutions, these companies have been able to command some very premium pricing for power. Now, the knock-on effect has been a much tighter supply for power, and we've seen instances of this, particularly in the northeast of the US, where we've seen forward pricing in the recent auctions increase by as much as 50%. Now, longer term, what we would expect to see is the supply-demand market to really normalize over time for two reasons. Firstly, we would expect that the regulated utility companies, which there are a couple of examples that David mentioned, really catch up in adding that capacity over time. And then the second leg to that is one would reasonably expect that over the longer term, we would see data center growth really slow down from where it is today. Now, the second negative influence that we've mentioned is the oil and gas pipeline sector. And really, this has been, over the last 12 months, really has been a story about volume as opposed to really any sort of dramatic price increase growth. There are two reasons for that. We've seen continued strong demand from gas-fired power plants, associated with data center demand.
Yep.
And then the second has been really, again, continued robust growth from the LNG export market. Now, I'd also be remiss not to mention that some of these stocks did benefit from the recent US elections, where President-elect Trump really ran on a very fossil fuel friendly platform.
Okay, so that talks a little bit about how things have gone over the last year. Let's talk a little bit about the outlook. Do you want to talk about the opportunities that we see?
Yeah, sure. We'll see some really good opportunities in the airport space. Ben touched on the growth we've seen come through. We're still seeing demand being very robust. So despite the cost of living pressures, aircraft are still full, load factors are still very high. That really speaks to the fact that capacity hasn't come back from a manufacturing point of view, from a new aircraft delivery point of view as expected. So Boeing and Airbus have both had problems. We had about 1,250 planes delivered this year. It's well below expectations at the start of the year. Current expectations for about 1,800 planes to be delivered this year. That's from IATA, and there's some downside risk to that. Again, about 44% increase. The backlog for new jets is about 17,000 planes, as high as it's ever been. So as Boeing and Airbus sort out their issues, we're going to see ramp up in deliveries over the next 2 and 3 years. It's going to add to capacity. It's going to help alleviate ticket prices, and it's going to help fill that tailwind to passenger volumes, particularly through those leisure-focused airports that we spoke about. Within the political instability framework that Ben spoke about in France, we've seen instability in the government there. We see the French-facing roads as pretty cheap. We're a little bit cautious there. Those political uncertainties could weigh on share prices for a while, but certainly they do look cheap to us. In the utility space, Europe looks cheap as a group. The utilities broadly are very cheap. In the US, it's a bit more mixed, probably fair value overall, with pockets of overvaluation, undervaluation. Where they're undervalued, they tend to be sort of short-term issues capitalised into long-term share prices, and that's where we're really trying to focus our attention and try and take advantage of those mispricings.
Okay, so no shortage of opportunity. Ben, what about the risks?
Yeah, sure. So, as we talk about, the nature of infrastructure is you've got very stable earnings, very predictable earnings. So it's not really the economic colour looking forward that's really the thing that keeps infrastructure investors awake at night. The thing I would flag are probably two risks. One's more of an investment risk, one's more of a business risk. On the investment risk, that's really to do with interest rates. What we've seen, particularly over 2024, is again ongoing volatility in interest rates, where you had effectively inflation cooling off, central banks cutting rate, and long-term rates declining with that. And you saw that kind of reverse after the election of Donald Trump, and rates have been going up. Since then, that's carried on into early 2025. And so off the back of that, it's not really the impact on the businesses themselves, i.e. their debt book. They're pretty well protected in general. It's a pretty slow moving issue for them. The bigger issue is just in the short term, what you find is the share prices get impacted. To the extent that you see upside risk to rates, we have probably a view that it's sideways to down, but that's not a tightly held view. These are incredibly hard to predict outcomes. So to the extent there's upside risk to rates, you could see some impact on the share prices of companies. That's something that we certainly think about. But from our perspective, the valuations on the current interest rate setting look reasonable, but it is something that we think about. The second area I would flag is something we've touched on already today, but really that sort of call it social license / sovereign risk issue. And it's something that we see particularly in context of a rising cost of living environment. And the thing that we really think about there is the impact that you have on cash-strapped governments, companies that aren't in good standing with their governments. A good example of that, for better or worse, is some of the French motorway companies that they're signed by governments a while ago and they're not well liked by current government. They're well protected under contract, which is something that we like about them. But it creates a risk, and as a result, you see things like governments attempting to apply taxes to these businesses. Now, from a risk management point of view, our focus is on identifying those risks, pricing those risks, and actually making sure that we're not overpaying in face of those risks that might be there. But as Offa talked about, some of those risks also, if you can price those risks effectively, create the opportunity for good investment as well.
Yeah. So in essence, there's opportunity out there. It's not without risk. We would expect infrastructure generally to deliver inflation plus 4 to 5 over a medium to longer term timeframe, and there's really no reason why we wouldn't expect to see a continuation of those sorts of returns, whether that's over a 1, 3 or 5 year timeframe. Now we know that markets won't necessarily move in lockstep with our expectations, but we can be confident about the nature of infrastructure, and that is that it will deliver earnings growth and therefore wealth growth over time with a high degree of confidence. Thanks for listening. Hopefully you've got something out of that in terms of understanding where we're at in the Magellan Infrastructure strategies. We welcome any questions you might have.